Bloomberg Audio Studios. Podcasts, radio, news.
The bird's doing well, by the way.
So the next milestone is like, he flies? Is he,
yes.
Is he
Great
there?
news.
Is he?
Yes. So I believe last week I was talking about how we needed to work on flying. Really good at perching, really good at eating.
Sure. You've been showing him YouTube videos.
We've been working on flying. He's pretty good at flying now. The thing is...
How are you?
I'm still working on my flying. It apparently came naturally to the bird. I have to keep reminding myself, like, this is a baby bird. Yeah.
When do they have their bar mitzvah? When do they?
I think he's, or she, we can't tell because it's a baby, is just entering adolescence. Because the bird will also, like, peck at you. Like, yesterday I was sitting on my shoulder and it was, like, pecking at my ear. And then I Googled it, and they go through a teenager phase where they, like, get into biting you for a little bit, and then they kind of grow out of it. Anyway.
Well, congratulations to your bird.
Thank you.
Hello and welcome. It's going to keep being the Bird Stuff podcast, isn't it?
I love it.
Anyway, hello and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money sometimes. I'm Matt Levine, and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
Katie, in your other life as an anchor for Bloomberg Television, you've been anchoring some Bloomberg Television.
Absolutely, because we had a little bit of a smackdown this week. I'm trying to make this as dramatic as possible.
It's like everyone loves a financial industry smackdown now. Ever since the classic Ackman icon one from like a decade ago, everyone's like, "Oh, a smackdown."
I mean, we'll never achieve those heights again. That set the bar, and no one's passed it since. But in slightly less interesting smackdowns,
smackish.
Last week, I believe it was, there was a splashy Bloomberg News article about how Jim Chanos has a short thesis when it comes to Michael Saylor's strategy. The idea being that you basically short strategy and you buy Bitcoin because strategy trades at a premium to its actual Bitcoin holdings.
Yeah, and one thing that Jim Chanos said that is entirely accurate and revealing and everyone ignored is that MicroStrategy also does the same trade in enormous size.
Yeah.
Right? I mean, like MicroStrategy's like kind of like fundamental business model is like, well, our stock trades at 2 times the value of the underlying Bitcoin. So we're going to sell a ton of stock and use the money to buy Bitcoin. It's like, yeah, of course, it's a great trade. But like MicroStrategy has some advantages in putting that trade on Jim Chanos doesn't have. Like they don't have to pay to borrow the stock. They can't get squeezed out of their short. But they were doing the same trade. But anyway.
Yeah. Well,
go on.
That was Chanos' position. We interviewed Michael Saylor on Tuesday of this week, and obviously he disagreed with...
Right. He was like, no, nobody should sell MicroStrategy stock to buy Bitcoin. That's a crazy thing to do. Why would anyone sell MicroStrategy stock to buy Bitcoin?
Yeah.
Except for him. But whatever. No, I mean, to be fair, he's not doing it anymore.
Yeah. Oh, he also said that, Chanos doesn't understand how, his valuation of strategy is offsides. That was on Tuesday. Jim Chanos came on Bloomberg Television on Wednesday with my colleague and friend Scarlett Fu and gave his side of the story. I mean, he said that Saylor is a great salesman, but basically his argument amounts to financial gibberish. I think he might have said that on social media and not on television.
I would. It's really the case that
Oh, wait. Let me read you the tweet, actually. It's pretty good. In response to Saylor's television clip from our interview with him. This is, of course, complete financial gibberish. Mr. Saylor wants you to value his business based not only on the net value of his Bitcoin holdings, NAV, at market, but additionally with a multiple on the change in that NAV, ! Because now he can leverage his balance sheet, LOL.
I mean, I'm sorry, that's correct. I don't want to say that MicroStrategy's thing can't work, right? Because it's worked, right? And a lot of people have gotten carried out shorting it, right? And I'm not saying, oh, it's a great idea, just short MicroStrategy. But it is gibberish, right? It's the point that they're making is Bitcoin has gone up a lot. And so when we buy Bitcoin, we're creating a ton of value for shareholders. And at some level that's true, but at another level, you just buy Bitcoin, right?
This is true.
And I think I probably said this on the podcast before, but a thing that is just wild to me about MicroStrategy in particular and Bitcoin treasury companies generally is you have to tell some story about why you're not just a pot of Bitcoins, right? And there are a number of ways to tell that story. And like, all credit to MicroStrategy. They've done all of it. They're smart. Like, they're good at like, this is a well-run Bitcoin treasury company with a model that I fundamentally don't understand, but like, they're great at it. But the sort of central story that they tell is like, well, we can be levered Bitcoin holders, right? Like, we can be, instead of just, buying Bitcoin and putting it in a pot, we can like borrow money to put Bitcoin in the pot. We can, Michael Saylor is like, we can issue preferred stock that pays 10%, and we can buy Bitcoin that goes up by 47% a year. And therefore, we're doing an arbitrage, which is like, nobody should ever say the word arbitrage again after that. But the thing that I find fascinating about MicroStrategy is that, like, from the shareholder's perspective, it is just not levered Bitcoin exposure. Like, the way MicroStrategy works is there's a $60 billion-ish pot of Bitcoin that trades at 120 billion-ish market capitalization, which means it's not levered Bitcoin for you. Like, if you put in $1, you get back 50 cents worth of Bitcoin, which is the opposite of leverage. Leverage is like, you put in $1, you get back $2 worth of Bitcoin. So I just find it somewhat crazy making. But here we are.
But the thing is, even if Jim Chanos is correct, which you're saying he is, that doesn't mean his trade is going to work.
No. He's sorry. I want to be clear. The thing that he is definitely correct about is that it's gibberish.
Right.
Like, just from an aesthetic point of view, it's gibberish.
That doesn't
mean the stock will go down.
That's the thing. And that's something we've talked about before with these Bitcoin treasury companies, is that in the stock market, people are happy to pay double, basically, in the case of strategy.
Like, the trade is fundamentally about that can't last.
Yeah.
Right? And like, you see cracks in it, right? Like, GameStop is now a Bitcoin treasury company.
Hey.
And like, issued converts this week, and the stock was down like 20% at some point. Like, 2 weeks ago, I would have said like, yeah, any company can like announce it's a Bitcoin treasury company and like trade at 2x the value of its Bitcoin. Like, it's not quite as true anymore.
Yeah, like kind of immediately it became not true.
Yeah, which is great. But like, but MicroStrategy still does. I mean, it's coming a little bit. But it is a little bit weird to me for Saylor to criticize Chanos, because as Chanos has said, and as I just said, Saylor was doing the same trade, right? Like, selling MicroStrategy. Like, MicroStrategy is in the business of selling its own stock to buy Bitcoin, right? So clearly, at some point in the fairly recent past, like this year, like, MicroStrategy has thought that Bitcoin was a better asset than its stock, right? Like, you could sell a stock to buy Bitcoin. That's no longer as true, right? Now they're doing a lot of weird stuff.
Yeah.
And they've moved kind of further away from equity, right? They started doing stock and convertible bonds, and then they moved into like this very high premium convertible preferred, and they moved into, I think, higher premium convertible preferred that has like less and less equity content. And now they're selling straight 10% preferred that doesn't convert into stock. So they're basically, if you just look at their actions, it suggests that they thought their stock was overvalued at some point, and now they think their stock is fairly valued. And I think he said on TV something like, watch out, Jim Chanos, because we could issue preferred, and, if the premium comes down, we'll just issue more preferred.
Yeah.
Which I took to sort of mean that they might buy back stock, which is also crazy making.
This might be what you're referring to. He said, if the stock trades at a weak premium, we're just going to sell the preferred. Yeah. And if the stock rallies up, he's going to get liquidated and wiped out.
Yeah, which doesn't exactly say we're going to buy the stock. But but I don't know, whatever.
So he also said, if the premium declines enough, he will issue preferred also in that scenario and then buy back the common shares.
Well, whatever. I mean,
he has a few different game plans.
Buy back the stock.
Something that I thought was interesting from that interview, which I'm still trying to formulate an opinion on, so maybe you can give me one, is, I asked him, you have all these copycat Bitcoin treasury companies that are coming out. Do you view them as competition? And he said, I don't view them as competition. I view ETFs that track preferred shares as competition, such as Invesco has one. I think the ticker is PGX. It has like $4 billion in assets. So I guess he's trying to compete for investor attention. Like, he wants investors to buy his preferred shares, not broadly preferred shares. I don't really know.
Interesting. Yeah, the Bitcoin treasury thing is interesting because he has, like, for a long time been a proselytizer for other companies should do this, right?
Yeah.
And when you think about, like, the model, like, Jim Chanos and I can talk about the premium all we want, but, like, fundamentally, Michael Saylor views MicroStrategy as a bet that Bitcoin will go up. And so, like, the main thing they want is for Bitcoin to go up, right?
Yeah.
And the more companies that devote themselves to buying Bitcoin, like, the more Bitcoin will go up and the better off MicroStrategy and its shareholders are, right? So, like, they're not competition, right?
Yeah.
Like, in a world of, like, enormous competition for people to invest in this thing. Like, would MicroStrategy's premium come down? Maybe. But if MicroStrategy's premium comes down by like Bitcoin going up 10x, then like that's great for Michael Saylor,
Mm-hmm.
The preferred thing, yeah, like I actually don't know who. I've always thought of straight preferred as a pretty niche financial product, right? It's like a lot of banks issue it, and there's some like utility ones. It's not like a huge. You don't regularly have tech companies being like, I'm going to issue a straight preferred, right? That's not like a real thing. Like bankers don't go around marketing 10% preferred stock to tech companies. And MicroStrategy is doing it in size. And yeah, I guess they're competing for like the fairly limited pool of like retail investors who want preferred stock. They're offering 10% and they're like, take our 10%. And I guess like surely somewhere out there's a fixed income investor who is like, I just want a safe, high dividend, and the best dividend paying stock that I can get is this MicroStrategy preferred. And I don't care about the business model, it's fine.
Don't tell me about that.
Yeah, don't tell me about it. As long as they keep paying the dividend. And that's a thing that someone might buy. I
could have seen him embracing these ETFs and other funds that track preferred shares, because theoretically MicroStrategy, so I don't know.
I don't fully understand it either, but like, right, to the extent that like instead of buying a diversified dividend fund, retail investors like, I want that MicroStrategy dividend, like
pure play. Yeah. Who won?
Yeah. Like to the extent that like I'm the judge of this match, like I'm going to award it to Jim Chanos on points. To the extent that like, we'll find out when someone gets knocked out, like Jim Chanos is going to exit this trade before Michael Saylor does.
That's true. Saylor's going to hold on.
He's going to do great.
On-cycle recruiting. You wrote that no one likes it.
It's amazing. They fixed it. They just fixed it.
Well, Jamie Dimon especially didn't like it, and you're right. He solved the problem.
So I have some backstory here. So I clerked for a federal judge after law school. And clerkship hiring has the same issues where, like, basically there's a pool of candidates and there's a pool of judges, and there's like a ranking of prestigious judges, there's a ranking of prestigious candidates, and everyone wants the best candidates or the best judges. And, it used to be that like towards the end of law school, you'd interview with the judge to get a clerkship. And then some judges were like, we'll interview a little earlier for clerkships to start in 2 years. And then we'll get the first cut at the best candidates. Mm-hmm. And it crept up earlier and earlier, and it became like untenable. And when I was a clerk, my judge was like the leader of the like clerkship hiring plan that told people you can't hire before like, the beginning of the third year of law school. And it was like kind of mostly enforced, but like a couple of judges defected and hired in the second year. And, I couldn't enforce it, but I was like in a dudgeon when people would hire clerks too early. And so I saw this process play out where like it got too early. Everyone was like, this is dumb. It's too early. Let's move things back.
Yeah.
And hire on a normal schedule where we can like see people's grades and like know what they're like, and not just like hire at the beginning of law school. And we set it back, and then like immediately it started decaying again. So I think that like private equity hiring is a little of that, where like there's a logical time to hire new private equity associates, and it's, as they get to the end of their investment banking jobs, right? It's
for
like
sure
3 months before those jobs end or whatever. And because prestigious firms want prestigious candidates, they'll be like, we'll just interview a month earlier, and then everyone rushes to keep up with them. And so now the hiring is like before the investment banking jobs start. And everyone thinks that's dumb. And so Jamie Dimon is like, that's dumb and we won't let you do it. And because he's Jamie Dimon, because JP Morgan is a big prestigious bank, like, they've had some traction where I think Apollo and General Atlantic have already said they're not going to hire people this year for their 2027 start dates.
But it sounds like you're saying you don't think that this truce of sorts will last.
I think in 5 years, we'll be reading articles about how private equity hiring is, starting before investment
and talking about it on this podcast.
Yeah, talking about it on this podcast.
For sure.
This is long run content for this podcast. Will this equilibrium decay like next month? I don't think so. Like, I think there's going to be like a real impact where like people who started private equity in 2027 might get interviewed in 2026 rather than 2025. Like that
Right.
could really happen because it has gotten sort of comical and like there is like some goodwill around like moving things back, but like will it last forever? I don't know. I don't think so.
Well, it's interesting. I took a dig in some of the Bloomberg historical archives. Morgan Stanley tried to do something like this.
Everyone's tried to do this. This is like a thing, yeah.
Well, in 2013, Morgan Stanley then abandoned their attempt to block first-year bankers from talking with recruiters for outside firms. Employees complained, and the complaint, this is all according to people familiar from the time, the complaint was that they're being put at a disadvantage to, other entry-level bankers at other firms.
I don't think JP Morgan could enforce this if the private equity firms hadn't come out in support of it. Like, the calculation at JP Morgan is not just, we will stop people from taking offers too early, because like that is really hard to do because, everyone going into banking wants to be in private equity. And like you'd lose analysts if you said you can't go into private equity. But I think because also the private equity firms don't love it, like it has a chance to succeed.
Well, that's what I'm curious about. So, Apollo kicked this off. Mark Rowan said in an emailed statement to Bloomberg, when someone says something that is just plainly true, I feel compelled to agree with it.
Yeah.
But is part of the calculation on Apollo's part that they're going to earn some brownie points with Jamie Dimon, and that's more valuable than, getting an early shot at some of these analysts?
I think it's both. Like, I think they're not kidding that it's dumb to hire people before they graduate from college, right?
Yeah.
For a job that starts in 2+ years and, interview them about like LBO modeling when they've never worked on a deal, right? Like it's genuinely dumb, like, yes, being in the good graces of Jamie Dimon is not a bad idea for any private equity firm, but like, no, I think I mostly agree with them. I want to tell you about a couple of like reader emails I've gotten about this topic.
Yeah.
So one is I heard from someone who was like, yeah, I started in banking. I accepted my PE job like immediately. And then after a couple of weeks in banking, I realized I didn't like to do deals. And so he like backed out of his PE offer, which first of all, like, yes, when General Atlantic and Apollo talk about this, they're like, we want to get recruiting right.
Yeah.
And if you're recruiting people before they start in banking, you don't really know that you're getting the people who really want to and will be good at doing private equity, right?
Yeah.
Like they don't know anything about, they've never worked on, well, whatever. This is part of a bigger process where everything has crept up earlier and become more intense. So now like you intern.
Well, we talked about university finance clubs a few weeks ago.
Like I'm like, oh, they don't know anything about banking, but they've been like doing banking since they were children. But still, like you get a better sense of who actually wants to do it if you interview people after like a year in banking than if you interview them after 20 minutes in banking.
Yeah.
I thought it was interesting that like this doesn't happen that much, like people backing out. Like he was like, yeah, my firm was then like advertising for someone to fill the spot really quickly because like they don't overhire. It's not like, an airline where they sell 20% more seats because they figure people will drop out. They just figure everyone they hire is going to start 2 years later, which is pretty wild. The other thing that I got is like a couple of people are like, you ask like, why is Apollo jumping to agree with JP Morgan? Like one possibility is they think that recruiting this early is not a good idea and they would like to recruit later to get more, have a more informed recruiting conversation. Another possibility is they want to curry favor with Jamie Dimon. A third possibility is that they don't need as many people.
Yeah.
Like a third possibility is you're hiring for 2027 and you're like, okay, in 2 years, first of all, like there's all this stuff about how like private equity firms have nothing to do. Like they're like can't get any exits. Like people are kind of bored. Like they're not doing as many deals. They can't raise money.
Yeah.
Might be good to tighten the spigot for 2027. And then there's also just like the theme of what AI will do for junior hiring in financial services, right? Like, so if you're like running a big private equity firm and you're looking at your need for junior headcount 2 years out, it might feel a little uncertain. And you might say, you know what? We don't need to hire everyone for 2027 right now. We can take a pause on that and see how many people we actually need in 2027. So I generally don't know, like if you were a junior, like if you're, about to start your banking job, like I don't know whether you'd rather have private equity recruiting now or not. Like it's kind of nice to have your entire future sewn up for the next 5 years. But at the same time, it's like stressful to interview now without knowing anything and without, having done any deals and commit yourself to, your jobs for the next 5 years. I would think it's better for candidates to have a little bit more time.
Yeah.
But not if like the reason for that is that,
the dystopian.
the dystopian future.
Yeah, that AI will just replace him anyway. Also, I wanted to talk about this a bit more from, the perspective of an Apollo or another PE firm. The reason why everything has been pushed, are we saying back or forward? Probably. The reason why
later.
The reason why everything is getting pushed earlier is theoretically because they want the best analysts. And it almost seems like a trade-off that to get the best analysts, part of the price you pay is probably some of the folks that you hire 2 years early before they have any experiences. Some of them are going to be duds.
Oh, yeah. Right.
Yeah.
And this is what they say when they agree with Jamie Dimon. They're like, we want to get the recruiting right. I did get one reader email. I was like, it's really hard to do recruiting. We've never found a way to be really confident that we're getting the right people. And so who did the good job in the interview and is going to Goldman is fine. To me, it seems like this would be a bad recruiting system because you would not know anything about people's performance. But the counter argument is yeah, you never know anything anyway, and that's fine. But yeah, I would think that you'd get a lot of duds or people who aren't motivated, or you'd miss a lot of people who don't have the most prestigious backgrounds, but actually kill it in banking, it seems like a worse recruiting process than waiting until people have done deals for a while.
Also in, all the coverage I've read about this over the past months and past couple of years, it just seems like there's only one pipeline to get into PE at the entry level, and that's to come from banking. Yeah. Do they hire from anywhere other than IB? Yeah.
Historically, some number of management consultants, some number of post-MBA people. But I think it's increasingly hard and increasingly the pipeline is the pipeline and there's one way to do it. Particularly because they're interviewing so early.
Well, we'll see how long this truce lasts.
Yeah. I think there's something interesting about people email me to be if they want to compete for the best people, why don't they just wait and pay more? There's a weird fungibility about both the people and the firms where it's we all have to do the same recruiting at the same time because we're getting the same people to do the same job. You could imagine one private equity firm going to people, a week before the job starts and say, look, I know you've accepted a job at another private equity firm, but we think you're good. We'll double your salary, right? You could imagine doing that. But I think it's not done, sort of frowned upon, and it's small enough industry that people wouldn't do it. But it is a strange thing that everything feels so fungible and it's such a direct competition for the same people to do the same thing rather than trying to differentiate yourself in some way other than hiring 20 minutes earlier.
Yeah. The grand convergence.
Right. There's a story in the Financial Times about Tower Research Capital, the very delightful high-frequency trading firm.
Yeah. One of the oldest ones.
Yeah.
If not the oldest. I don't know.
It's hard to know what counts as a high-frequency trading firm, but they're a sort of big, established high-frequency trading firm. And they're apparently launching a hedge fund to run outside capital because, you're a high-frequency trading firm. You run your own capital. You get market signals that tell you what stocks to buy in the next 3 seconds.
Yeah.
And those signals throw off enough exhaust that you can be I'll know what stocks to buy in the next 3 minutes, right?
Yeah.
And you you reach your capacity for how much of that you can do with your own money. Mm-hmm. And then you're well, open up to outside money and charge people 20% for telling them what stocks to buy in the next 3 hours or whatever. So it's an interesting convergence of what hedge funds do and what high frequency trading firms do.
Yeah, this is an interesting one. I liked this phrase that was in the FT article. Let me find it where I put it in my notes. Oh yeah, I like this. Mid-frequency strategies. I haven't heard that before. We talk about high frequency, but now we're talking about mid-frequency.
You and I run in different circles.
We do.
Mid-frequency. I don't know what it means because I think different people have different, I think there are definitely people in the world who you're oh yeah, I'm a high frequency trader. I trade every couple of days, right? But when HFT people say it, they mean when HFT people, you're I trade every second. They're oh, that's so low frequency.
What a pedestrian pace of trading.
I've said milliseconds in articles and people have been milliseconds are so slow. What are you even talking about? But no, mid-frequency is somewhere between a microsecond and an hour.
Yeah.
No, sorry. It's somewhere between a microsecond and a month, somewhere in that range.
I do like to imagine like a full circle moment, though, like Tower being an example of, okay, they're, going out the time spectrum and maybe just we end up with long-only fund managers at a certain point.
I don't think we're going to end up with, well, I don't, sure. Like, this is the thing, like, people who are doing a lot of quantitative research into like signals that tell them what stocks to buy and sell, there are different ways to use that. And often it's like at different timescales where like, if you have like a pretty good method for knowing which stocks are likely to go up or down, like one natural thing to do is to like buy the ones that'll go up and short the ones that'll go down, right? Mm-hmm. But another thing to do is you buy the ones that'll go up and not short anything and run a long only fund, right? And so you have like, AQR and other people who run, hedge funds and also are like, well, just take the long signals and run long only money because people want long only products. Or like, I was thinking about like other examples of this kind of thing. And like you look at Renaissance and it's never clear exactly what the dividing line is, but like Renaissance, has a very famous, extraordinarily successful hedge fund called Medallion that has been closed to outside money for decades now because it's too good. And it only has so much capacity, right?
Yeah.
And so they close it outside money and they run their own money and they make themselves billionaires. And then they're like, well, but we have all this like, it's like pretty good signals that, like we reach capacity on our own money, but like we can use those signals to run institutional money and like not quite as good, but like good enough. So there's a lot of that where like, people who have really good signals that have limited capacity will run their own money with those really good signals. And then like there's some second tier of like we can run other people's money and still be pretty good.
Yeah. I mean,
by the way, I don't know that Tower is advertising that. Like maybe they're like, oh, our like mid-frequency signals are even better. You should definitely get in on this, right? But like I do think in Renaissance it's like quite explicitly the case that they're like, we have really good stuff for us and like okay stuff for you.
Yeah. The article doesn't go into that, but it does say that this would mark one of the first examples of a large, high-speed proprietary trading shop opening a product for outside investors.
Yeah, sort of. Although like Jane Street has issued bonds, right?
Yeah.
Not a product for outside investors per se, but like the idea that like you are a big successful proprietary trading firm and so you use outside money to grow your business is not like completely unheard of.
True.
And also I think some of them have taken like outside equity investments, although I'm not sure about that.
You touched on this, but one of the quotes in the article attributed to a person close to Tower is that there's just a finite limit to the amount of money that you can make with the really high-frequency strategies. Why is that? It's just because they're dealing with the likes of Citadel and Jane Street and trying to compete against them? Or what does that mean?
Well, like, stocks don't go up that much
so is that just
in a microsecond, right? Like what is investing, right? Like you're like there's a sort of deep question here. It was like, why should you make money by buying stocks, right? And the answer is in like the long term, because you're allocating capital to its best uses. And you are saying this AI company is going to transform the world. And so if I invest in it now, it'll like 10x my money because like it'll be transformative to the world, right? And if you're like, why should you make money holding stocks for like 1/1000th of a second? The answer is because you're providing a tiny, tiny liquidity service to somebody, right? And like, it turns out that you can make a really nice living providing a tiny liquidity service to people, but you can't like, make $1 trillion, right? Like you're not like allocating capital to like changing the world. You're like, yeah, like providing a little service, right? So like there shouldn't be that much money. Like there's a lot of money in very high frequency understanding what stocks will go up in the next 100th of a second, but there's more money in understanding like how the economy will transform in the next 10 years, right?
Yeah. Because I read that quote and I was like, isn't that true of a lot of things?
What do you mean?
Like there's only a finite amount of money that you can make. like
I don't think there's I think the one place where there is not a finite amount of money is in like understanding what companies and technologies will be transformative for the world, right? Like if you like pick where economic growth will be, like you can make $1 trillion, right? Like not really, but like, I mean, you can, right? I mean, like, Facebook is $1 trillion company, right? Like you can like know what the future will look like and make $1 trillion, right? Like you can't in most businesses. Like, you're like providing a service. Yeah, there's a limit to how much money you can make.
Well, there's a quote in here from a professor over at the University of Illinois who also, here's another quote that just made me think a little bit. If you're a firm that gets really good at mining gold, why stick to just mining gold? It's like, well, because you're good at it.
I didn't understand that.
That was another thinker.
Nice living.
Yeah.
Mining gold, right? But
that's like asking you,
it's like
you're really good.
You're really good at writing a newsletter. Why not? Why stick
Launch
to that?
a podcast.
Why not launch a podcast? And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on Open Interest between 9 to 11 a.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question and we might answer it on air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff Podcast is produced by Anna Mazarakis and Moses Andam.
Our theme music was composed by Blake Maples.
Brendan Francis Noonan is our executive producer.
And Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff Podcast. We'll be back next week with more stuff.